What is beta in mutual funds? Will analyzing beta benefit investor? To help you get answers to such intriguing questions, we have our financial expert Mr. Hariharan with us. Hariharan, the screen is all yours.
Now, beta is essentially talking of what kind of returns can I expect from a fund relative to market. Please remember the word is relative to market. So market is supposed to have a beta of 1. I could have a fund A which is having a beta of 1.2. I could have another fund which has a beta of 0.8. Now let's understand how this works. So beta is relative to market performance. How much can my fund perform or deliver? So if I have fund A and B, and if the market has delivered 10% positive returns, fund A, which has a beta of 1.2, will deliver 10 into 1.2, which is 12% returns. So higher the beta relative to market, more is the performance. On the other hand, fund B, which has a beta of 0.8, will deliver 8%, 10 into 0.8, 8%. So what beta tells us is relative to market, what could be my performance from the fund. So from a cricket example, let me quickly give a cricket example here. Suppose there's a one-day international match. The team batting first has scored 299 runs in 50 overs. So the team batting second has to score 300 runs in 50 overs. So run rate required is 6 runs per over. There are two set of batsmen available. Batsman number 1 can score 120 runs in 100 balls. So he has a strike rate of 120. I have another batsman 2 who faces 100 balls, scores 80 runs. So his strike rate is 80. Right? So that's the example you are looking at. Imagine if batsman 1 were to play the 50 overs, who is striking at 120 per 100 balls. Target is 100 runs in 100 balls. So if he were to bat the entire 50 overs, you will not even need 50 overs because he's striking more than what is required. So he's scoring faster than what is required. On the other hand, if I allow batsman B to play the 50 overs, he will score 80 runs in 100 balls. He will consume 50 overs and score only 240 runs, and I will lose the match. So one batsman is playing faster than what is required. One batsman is playing slower than what is required, and that's beta. One fund is scoring faster than the market. One fund is scoring slower than the market. Getting the point? We have only looked at positive market, and therefore we said we want A. Markets can also fall, markets can correct. So if market falls by 10%, what will happen to fund A? It will fall by 12%. Fund B will fall only by 8%. Very important point. Therefore, when you select funds based on beta, you will have to select funds basis what is your risk appetite. And if you recollect risk appetite, we started with the first one, aggressive, conservative, moderate. You will select funds which are having beta more than 1 and reasonably higher values, 1.3, 1.4, 1.6 kind of funds. On the other hand, if you're a conservative investor, as per this profiling, you should select funds which have lower beta. When I say lower beta, less than 1, 0.7, 0.6, 0.8. Medium, moderate investors should select funds which have beta very close to 1, 0.9, 1.1, those kind of funds. Is it clear? So when you now select funds connected to what we started with, basis your risk appetite, you will have to select the funds based on their beta.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.